Hello and welcome to the Investing Master Series. My name is James Boyd. Alongside with me, Barbara Armstrong in the chat. We welcome her and all of you here this morning. We got Jay Richardson with us. Aloha, Scott, back to you. Scott, give me the update. Is that place drying out over there? Let me know. Got a wedding over there in 2 months. Okay. And also Kevin, Dom, James L, 561, and many others. Welcome to all. Now, just real quick, if you have questions, go ahead and type those questions in the chat. I don't mind the questions. What are they? So let's go ahead and hit those. Now, today I want to kind of talk about, maybe potentially getting out of maybe two bearish positions. Two, I would actually like to talk about some caller examples that we actually have and maybe how to manage those positions. Now, a lot of the things when markets become more volatile is how do you manage that, those positions? So I'd like to kind of take a look at let's say 4 or 5 off the start. And then we're going to talk about some examples that might be bucking the trend. And we know that this is the last day of the quarter. We saw some bullishness this morning. We'll talk about that. Is it changing the trend or is it just an up day? We'll talk about that. Now, as we get started, remember that Barbara and myself, you can find us on X. There's my handle at James Boyd CS. Barbara will post her handle in the chat. That way you can just click on it and follow her as well. Now, just real quick as we get started, remember that when we talk about options, options carry a high level of risk and are not suitable for all investors. Also, when we talk about the information, it's done for general informational purposes only. When we talk about our examples, we will do those on the Paper Money software application. And also remember that investing involves risk, including loss of principal. And the biggest thing what we want to really focus on here today is getting confidence in managing positions. When you do the same strategies over and over again, you should be becoming more confident in how to manage those positions, when to put them on, and so on. If we talk about short options, remember that those short options, these are what's called American style options. Those could be assigned prior to expiration, regardless of the in-the-money amount. These are American style options that we're talking about, not European, where you could only do it at expiration. Now, when we talk about our examples, we will look at the market conditions. We'll talk about some current examples, and then we'll look at some new ones as well. Let's hop right in and let's take a quick peek at what we have. So first off, I think when we talk about the indexes, no one's going to tell us here today that they're uptrending in the shorter term. If you look at kind of what we have so far, the candle-wise, it's a green candle where the moving averages are still red, okay? We talked about this yesterday. When you talk about the momentum, these green candles have struggled to go up more than 3 days, which is kind of more telling us in the shorter term, there is a bearish shorter term downtrend. Noted. So we can't say today is a reversal of the trend. Could there be some stocks actually up? Yes. But remember, if the S&P is actually down, that actually tells you that more stocks than not are down. Okay. Now, while we're on here, let's go look at the VIX. We talked about how the VIX yesterday was at 30. Today, the VIX being a little bit less than before. Still sitting at 27. Changing the direction of the trend? Nah, can't say that. Now, if we take also a look at, let's say, some things like the US dollar, okay, some of these we tried to get above that $100 level, sold off a little bit from that. Now, remember, if that chart goes up, think about investors moving to cash. Well, wait, if they're moving to cash, what are they selling, right? Now, they might be changing allocation. Maybe they had a focus in stocks and said, look, I want to move my money to cash, at least for the time being. That doesn't mean they stay there forever, okay? But if that chart's actually going up, some investors are saying, look, I want to be a little bit more in cash and in the US dollar, which tends to be more liquid than some of these other currencies. Now, if we also look at crude oil, just real quick, we talked about that, how that was actually, did close at that brand new high yesterday. That high being over $100, okay? Here we are at 104. The thing is, the straight, right? It's not if it's going to open. It's when. As you saw, that this we said before, this is not just a U.S. problem. This is a world problem, okay? And so when we talk about this, when is that straight going to open and release that pressure? But clearly, when we actually look at crude oil, that pressure is still there. The last one we'll actually bring up just really quick, the 10-year rate, we saw it drop down. This is a welcome sign, okay? That rate on the 10-year, 4.5, it's at 4.3 right now. So of the four that we talk about, right, crude oil, VIX, US dollar, and interest rates, the one that's really kind of given back a little bit more, not substantial, but hey, at least helpful, is the 10-year interest rate. Now, when we talk about, let's say, let's bring up a couple of these examples, okay? So first off, I want to kind of bring up, let's talk about a stock first. Now, one of the situations, if we're bullish investors, and I know many of us are, so my teaching is trying to focus on what the investor might be, what they have been doing. The second point is what they might be doing in the future, okay? Now, what investors have been dealing with, if they're long-only investors, that means they only buy thinking the price is going to go up. We've been dealing with this situation where the trends are in trend 5, flickering back to 1, trend 1, trend 1, trend 2, okay? Now, most of the things that we have in the portfolio, they have been in trend 1, which just means price down below both moving averages. Now, I want to kind of just show this just real quick. So here it is, 100 shares of stocks, and we're in the stock section of the portfolio. Now, I want to kind of just take a look and kind of just verify. So if I look at Delta and if I just take the lines off, is there a stop on this? Yeah, there's a stop on it, okay? There at 60.47. We got a target there, 72.50. Now, Delta is not materialized in terms of going up as the price per barrel of oil has actually gone up, okay? So it's pressed down. Again, some people playing the correlation, okay? But that is under stress a little bit. And how bad is it? It's down $12. If you have 100 shares, you're down 12 cents per share. So this is a non-issue. Going to go to the next one. We know that we're just kind of looking for the price to oil to push down, okay? And seeing if Delta can get a little push. Now, this one right here, long or short. Now, obviously, if we're long, we bought it, we're plus. But if we're minus 50, that is short stock. Now, we sold it at 99.83. Now, this goes back to the old saying, the Southern saying, buy low, sell high. If you're long, if you're short, you want to sell high and then buy back low. Well, here we sold at 99.83 and we're here at 94.61. The question we got to ask ourselves is now, when do you get out? So the position is up $261. We're now looking for signs of reversal. Well, what would be signs of reversal? Well, just like what we would kind of see the opposite, if I actually pull up that position, we're going to pull up and we're going to use the exact same chart, if you don't mind. And actually, no, so first off, let me show you this chart. When we're looking at the trend candlesticks, okay, the color of the candles, they have been red. I mean, this has been ugly, okay? And we have not broken above the 10-day moving average. Could some investors move the stop right above that 10-period moving average? I think that might be the simplest thing to do, right? Well, where's the 10-period moving average? Well, if you look at where my pencil is, it's 96, okay? 96.06. If we add 2% to that, well, if we times it by 1, it's going to be the resistance, the 10-day moving average. If we times it by 1.02, it's 2% above 96.06. And if we come back and do that, we're just going to move the stop down to 97.98. So if we do that, 97.98, right about there. Now, if we do that, it's just going to move the stop. Now, remember, that stop, whether we talk about bullish trades or bearish trades, stops are market orders. They're not exact. It's a trigger in this case, not to sell. It already sold. It's a trigger to buy the shares back, thinking that the price could be reversing back to the upside. Now, Let's go back to the whole moving averages, which are more sensitive to price movement. Now, if I pull this back up and say, okay, what do we got on this chart? Is there any signs of bullishness yet? Yesterday, there was a close above the high of the low day. That's the strongest thing we could say. If you said, James, if we get that 10-period moving average to go green, I am going to cover that position. What do we mean by cover? Well, cover means you're just going to buy the shares back. Okay, so we looked on both charts to show kind of a slowed down view, the 10-day exponential moving average. If we use a whole, which is like weighted, you're going to see that with faster, in other words, if you think of it like that, we don't see that change yet. But if this goes up much more, that 10-day whole moving average could actually start to turn green. That might be for some investors to say, look, I'm going to get out of the position. We're starting to see reversal. Okay, so we don't see that yet. The only thing we see on this is just the hold so far. But keep an eye on that. Remember we said before, the first signs of bullishness is that the 10-day moving average goes green. What might cause that? The candlestick, price action, right? Now, if we take a look at, if we go back to, let's say, I want to go back to Lululemon just real quick. Same idea here, okay? Lululemon went bearish at 164 and change. It's at 150. That's not bad. It's about 10% drop, right? Now, that's helped the portfolio about $715, being just bearish. Now, this is a stock position. We go back to Lulu for just a moment, and with the same idea, if we actually look at Lulu and say, do we see, now let me ask you this question. Do you see any signs of bullishness, the keyword is yet? Any signs that this might be reversing? Yeah, now the comment came is the 5-day whole moving average is green. Yeah, that's if you're using a 5, which is ultra sensitive, okay? Now, the one thing we could actually say on this is, yes, we see the price getting above the 10. So again, it starts with price, right? Moving average isn't moving by itself. So the price being able to get above the 10, and maybe that candle is a bullish engulfing, a piercing line, a hold, whatever, all the above. That's the start, right? That's what we're talking about this. Because we don't want to just have those gains just go all the way. We want to actually try to capture some of that. Now, let's go back to just, so on this chart, what we see is price going up. Is the price going up changing the moving average yet? No, not yet. If we go to that moving average that we talked about, the 10-day exponential moving average, the color of the candle there is still red. We're not above that 10-day exponential, which lags a little bit more than the whole moving average. That trend is still there. Could the 10-period moving average be like the line of resistance? It could. But I think the biggest thing is same idea as what we talked about in Disney, watching that, adjusting the stop down. If we actually looked at this and said, could we just maybe even run a tighter stop? Well, if we took 154.90, add even like 1% to that. And if we did, we're just going to times it by 1.01. We're going to say 156.44. So if we get 1% above that 10-day moving average there, remember, this is a stop. So this is going to try to trigger it to buy it back if we get at or above that price, even if I'm not even here, okay? Now, what happens if you see that moving average turn green? Well, that could be the first sign to say, hey, I'm going to exit the position. That's the first earliest sign. Bearish is just the opposite of bullish. Well, how do we actually set that stop up again? 156.44, we're going to right-click on it. Then we're going to create closing order, and we're going to buy those shares back. Now, if we buy those shares back, 156.44, there it is. We're going to, in this case, go limit to stop data GTC. So now what you're going to see in this case is there's the shares, okay? Going to buy them back. If we get at or above this price, stop GTC. Now, here's the deal, okay? When we talk about this, we practiced a couple of these. We said one way to practice learning bearish trends is this type of strategy. We said we're going to practice it in the pay money account. We're going to practice it in the margin account. You've had some opportunities to practice. We're just following through on some of those examples. and I want to now go and see if there's any questions. Remember, this is not buying it now. This is saying if we go at or above this price, then buy it back. Could it be filled at a higher price level? Yes. Okay, send the order. Now, the comment came in from, please point to the lesson where you talk about those customized bars above the chart. I'm not sure if I have it. Let me bring up an example. I want to go back to just real quick Netflix, okay? Now, so these customized bars above the chart. I'm not sure if I have like a specific lesson talking about this, but as we bring up an example, we'll just mention it. So first off, let me kind of use the pencil here. So this is a way to kind of like what sometimes investors do is they bounce around in different views, right? Sometimes people like to be on the charts more. And so it's just grabbing some information that they might want to know, like, well, year-to-date change, like, let me grab a different color there, like month-to-date change, okay? Like week-to-date change, PE ratio, dividend yield percentage. If it says 0, they don't pay a dividend. Percent down off the 52-week high, percent up off the 52-week low. So in other words, they're taking the low and saying, what percent are we off that bottom? Okay, 26%. Obviously taking a look at that high and say, what percent are we actually off that high? And so on. Now, if we take a look at this, the percent placed in the 52-week range, okay? So think of this as if we had, let's say, a high and we had a low. Well, if we were at the 50 percentile range, that means we're in the middle of that range. The high, which represents 130, and the low, which represents 70. So if we were at the 50th percentile, we would literally be at like right at right at the $100 price. Because if you had 130 and 70, 100's in the middle. The price is 100. But what percentile? Well, you'd be at the 50th percentile. That's smack dab in the middle. Okay. Now, if we go up a little bit more, we'd be pretty close to that, right? We should be right at that 50th percentile. Now, last earnings beat kind of gives us an idea. Percentage of stocks above the 50-day moving average, which we talked about yesterday. So you're kind of getting a fundamental point of view from the company itself, but also you're trying to take a look at, do you have the S&P 500 at your back? More stocks above the 50-period moving average, right? And so that's kind of important because your stock is not in isolation. It's one of the stocks on the ocean of the S&P 500, okay? And you could be getting help from that, right? We know that kind of, it's just like in real estate. If you buy a house and the neighborhood value goes up, the city goes up in value, the state goes up. It's not just your house, okay? I mean, come on. Same idea. Now, I want to kind of go back to this. Let's bring this up. We talked about this yesterday. And what I want to do is I want to go back to this chart right here, okay? So if we're talking about taking like an entry and we're looking at, let's say, more the moving averages that are more sensitive to price movement. Well, that's whole moving averages, okay, in our example. Now, what you're now going to notice is when we talk about bounces, right? Well, when we talk about the crossover, and let's just label this 1, 2, 3, right? The first sign of a reversal, which we just talked about, is the moving average goes from red to green. Well, no, yeah, that's true. Red to green. And that is really the first sign that maybe that bearishness is starting to abate a little bit. Now, what would be number 2? Well, the moving average crosses over. It did like the day later. What would be sign number 3? More confirmation. 3, you need to decide, and sometimes it's so hard for people to decide. So when you don't know, you might say, look, I actually don't know. I'm going to take number 2. Fine. Okay. 1 is the earliest. Early is good sometimes, but it's early. 3 is more confirmation. The confirmation is not free. Okay. Now, if we take a look at this, we've had 1, 2, 3, reversal. Now, remember, you want to know that because if you do bearish trades and you're starting to see 1, 2, 3, that bearishness is starting to turn to bullishness. I'm talking about the price. Okay. Now, what do we notice here? Now, you're going to see that we've had 1 down day and then we went up green candle, and then today, that is trying to bounce back to the upside. Now, are we closing above the high of the low day? No, not yet. Now, as my friend would say, if I put my order in, it would. Okay, my friend was always so confident. His one contract would knock it over the top. It didn't. Now, the big deal is when you take a look at this, some investors might say, James, I'm just trading the moving averages really being that green color. Some investors might say, James, I want to wait for that hold to actually occur, which could even be intraday. Now, I'm going to go back to this. Now, remember what we've been talking about the last couple of weeks is dollar cost averaging. A lot of times when actually things go up, people think they have to shoot all their wad of capital in one shot. I like to think about investing like dating, okay? And I want to kind of see the trend of our relationship strong, and then I'll commit more. Same idea with investing. Show me an uptrend. Show me we're making higher support levels. Show me trend. Show me more momentum, and I'll show you more money. Okay? So the trend needs to do something. Now, a lot of times people they struggle to understand this. I have no clue why. Because the biggest actually thing is, when we talk about it's just breaking down. Well, I can tell you why. Number one is if you ask someone, how much do you invest in any one given position when you buy, they can't give that answer. So that makes sense why they can't answer it. But if we actually said, look, in any given trade, we're going to invest 10% of the portfolio value, maximum. And that's if we said, hey, we're going to use this account, $39,000, 10% would be, let's say, $3,900. If we did, let's say, the IRA, we said, look, the maximum we're going to do there is 8%. What's 8% of 152,000? Define percentages. And then once we know the percentages, we can figure out the dollar amount. Now, what I'm going to do in this case is if someone said, look, I think the price might go up, they're now going to pick from some strategies. Now, we know that when you pick a strategy, okay, we know I call it a delta scale. Now, I'm not going to go over it all, right? DS, delta scale, okay? Now, we know that if someone said, look, I think the stock's going to go up, and I don't mind to put capital out. Well, they might do a stock position, and that stock position is a dollar for dollar movement. Stock goes up a dollar, you're up a dollar, okay? Now, that movement or gain is going to be based upon how many shares you buy. So we buy 70 shares of stock goes up a dollar, we make $70, unrealized gain. Not a surprise. Now, if someone said, well, I don't have any capital, well, you're probably not buying shares. But if we actually said, we got some cash, we might want to try to maybe invest some of that cash in the trend. Now, we can talk about that yesterday. But let's say the investor said, look, I want to sell something. I want to kind of come over here to the left-hand side. Zero would be, I don't have a position. Right above that, we actually have, let's say, like vertical, okay? A vertical is probably going to be about a delta of 10-ish per contract. And if we're right above the vertical, it's going to be like a cash CSP, a cash secured put. In our examples, we sell out of the money. Out of the money puts is probably going to be about a delta of, let's say, 30 to 40 or so. That normally is going to be about 2 to 3 strikes out of the money, typically. Now remember, if you go over to this hand side, you're trading probability. We go over here to the right-hand side. If you pick a stock position, you're trying to go for the money, honey. You're trying to say, no, I know exactly where it's probably going to go. And if I'm right, I want to get the payout of that forecast. Now, you don't know if you're going to be right. You're going to have to see how it trades out over time. So now you need smoother markets. You need that volatility to be high and dropping, or the volatility low and slow. Now, if you actually think there's more volatility, and there might be in the future, you might pick strategies that are to the left, okay? Now, anything to the right of zero, those are bullish strategies. Now, if we come over here and say, look, I want to try to sell a put, And there was a question on this, so I'm going to go back to this. I'm going to go back to the margin account. We're going to go back. Now, remember, the Aprils only have 17 days left. That ain't much time. We're trying to launch a position with more than 20 days remaining. So we're closing that up. We're going to go to the May expiration, 45 days to expiration, and we got calls on the left, puts on the right, and we're going to go look at the out of the money strike. Now, James, wait, you said before, typically the out of the money put would be probably 2-3 strikes out of the money. Well, that's true, but that's not true if they have dollar-wide strikes. Dollar-wide strikes, you have more, obviously more strikes every dollar in this case, and it's not 2 to 3 contracts out of the money. It's like 4, but you have dollar-wide strikes, okay? Now, if the investor said, James, I want to sell something, I want to sell, and remember, double check the liquidity. Do not assume that there's liquidity, okay? Liquidity can change, just like people's moods. Now, the biggest thing is we got bid 360, ask 370. Now, if we take a look at this, when we look at the open interest, 2,000 contracts. Those are the number of contracts that are open still and unexercised. This could be future liquidity, okay? If they close those positions out, right? Now, if we sold the 91, we're going to right-click on that. We're going to sell. We're going to go to vertical. Now, the reason why I bring this up, there's a question on this. James, when you did this yesterday, you did not buy the downside put. Let's do that for the example. Now, in our examples, we just look for the put that has a delta of 10 or less. Why a delta of 10 or less? Well, number one is if we buy a put with a delta of 10 or less, it's way out of the money, meaning the strike is pretty low relative to the current stock price. Number two, you're just trying to have a built-in maximum loss. 3, you're not trying to pay as much for it. 4, if you don't pay as much for it, your credit is still fairly well. Now, if we take a look at this and say, well, if we buy the 78, then what is the credit? Now, let's kind of show this. If we sold the 91 by itself, you get $3 and maybe 65 cents. But if we buy the 78, let's say we pay about 88 cents. And so it eats into the credit a little bit, quite a bit, okay? Because there's downside risk management. Think of the 91 as you have an obligation to buy, and think of the 78 as you have a right to sell. Buy it at 91, sell at 78. What does that mean? Well, you have a built-in maximum loss. And that built-in maximum loss is 1,023. How do you get to the maximum loss? Well, the stock needs to be below $78. Okay? Now, Bill actually says we got the tree story yesterday. Don't go there. Okay? But that little it's getting a little bit better. I've been scraping it down. So the reason why I brought up the tree story yesterday, by the way, chainsaws and James Boyd, I've been disallowed. My wife took all those power tools, and I get the Fisher-Price tools now. Anyway, it's not that bad. Now, the biggest actually thing is, if we look at the credit, 277 less the commission, and then what we're going to do is send the order. Now, remember on that, this is a bullish trade. If we actually went back and actually just double-checked and said, can we see real quick, what is that? Just pull this up. If we look at let's take that off. What do we got? Now, in this case, when we pull this up, it's pulling up Apple. Let me actually bring this position, right click, analyze the trade. There it is. Take that off. So when we take a quick peek at this, that's what the diagram is going to look like. And that diagram, okay, if you do, let's say, long call verticals, short put verticals, that diagram you should know very well, okay? Now, when we take a look at, let's say, well, what's the delta? Well, the delta, we can kind of just look and say, well, we get 35 delta if we sell that one, and we actually we're buying the 78, okay? So what's the delta? The answer is 25, okay? It's positive 25. So if the stock goes up $1, about $25 on realized gains. Stock goes down $1, down about $25. Now, if we were more bullish, the investor might just sell the 91 by itself. The con about that is you got to outlay more capital for the potential obligation to buy those shares. And there's not a built-in defined risk unless the stock goes to zero. Many people don't like that. Confirm send, send the order. Yeah, I know. I know. Amber's hard on me. She's real hard on me. All right. Now, are there any questions with that? So what we did is actually we went back. Now remember, when we see trends, it's in a trend, there's probably not going to be one entry. If it's trending, there should be multiple bounces in that trend. There might also be multiple highs in that trend. Okay. Now, I also want to go back and just see if there's any questions. So no, we're just adding to the position. Now remember, dollar cost averaging, when you dollar cost average, it might just be that you bought shares and then you added shares. Let's say you bought shares yesterday, but then today you sold a put. Dollar cost averaging doesn't necessarily mean that you have to buy shares again. You might actually overlay on the top of that something that has a different reward to risk type of profile to it. Okay. That's all we did. Okay. Same idea. Now, the earnings, when are the earnings? It's on the 16th. Now, we've said this before, is that when these stocks have earnings, sometimes they can give those investors they're trading something to shoot at, maybe trying to interest them in putting on some trade ideas. Now, in this type of trade, we're not trying to hold, let's say, for example, over the earnings. We're trying to see if we can't get the move prior to the earnings. All right. Now, let's go to another one. Now, I want to kind of fast fire. When we look at, let's say, a stock like Merck, I don't have anything to say. We did take a long position on that. That stock got pushed down yesterday, but it's trying to get a little bounce here today. Merck, and we're not going to add to that position because I got some other positions I want to look at. The other one that's actually done quite well, or at least trying to get a reversal, is Johnson & Johnson. Keep an eye on that. We also brought up the trucking idea, the trucking issue yesterday with diesel prices going higher. Could they be doing, let's say, more rails? I'm not going to talk about that. I want to put on some different positions. CSX trying to get a bounce. Intraday, right, the 10-period moving average. Its twin cousin, the UNP, not as strong. We did CSX yesterday. Keep an eye on UNP. Can that also get a bounce as well? Now, if we also go back to, let's say, I want to bring up Target just real quick. Now, a couple of these stocks, like Costco, okay, like Walmart, think of these Dollar Trees and so on, they've actually held in there pretty well. One of those stocks that's actually done a pretty good job as far as being up near the top is Target, okay? I mean, if you look at Target, last week most things went down. Target went up. That's classic relative strength. Now, if we pulled up the relative strength on the chart and said, let me see it myself, let me show us, and if I double click on that, you're going to see that it's the relative strength over the last 10 days compared to the S&P 500. Now, if I click on apply and OK, what are we probably going to be seeing? Remember, that bar, the red bar, that's the S&P 500. The green line, that's the performance, the relative strength performance compared to the benchmark, hence the bar, the S&P 500. Well, what do we notice? Well, for a long time, we were underneath the bar. The performance relative to the S&P 500 was poor, okay? But this green line, the relative strength performance to the S&P 500, it's been increasing and increasing and increasing and increasing. And for the first time in a long time, the performance of Target has outperformed the S&P 500 performance for the first time in a long time. Now, got to ask the question, geez, if people are willing to buy when it struggled, could they buy it when there's trend and momentum? Now, I know what you're thinking. James, wonder if we get in, it doesn't do what we thought. Well, speaking of that, some investors might say, look, what I'm going to do is I'm going to try to buy. Now, by the way, let's pull this up on the weekly chart. Let's not get ahead of ourselves. Okay. So if we go to the daily chart, 3-year weekly, this is what we see. Now, remember, we talked about this kind of coming out of the reversal pattern, and you're going to kind of see it's held that 105-ish. We kind of look and see where we are now. Where are we? We went up to that 120, and then right above that, the 120, that area of, let's say, 127-ish. Now, I'm going to come back to this for just a moment. And so let's imagine the investor says, look, I'm a stock investor, but I'm not sure, like I could pick a good stock, but the market could sideswipe my trade idea, sideswipe my investment. I could be in the stock thinking it's going to go up, but other outside factors like Iran and what's happening over there overnight when I'm sleeping in bed, I'm not even awake. They can be pushing down my investing idea. I mean, come on. Now, step number one, what we're going to do is we're going to actually click on the ask price. Okay. Now, going to click on that. We're buying, example given, 100 shares of stock in this example. Now, by the way, how much is that? About $11,000. Now, when we do this, we're going to come back to, let's say, that IRA account where it's a bigger account. And what we're going to now do is we're going to come over here to the call side first, and we're going to sell something that has a delta of 30 to 40. Now, that delta right there, 30 to 40 on the call side, that means that we're usually 2 strikes out of the money, right? 2 strikes out of the money. In this case, we do not have dollar-wide strikes. So that's probably a true statement. 2 strikes out of the money, 2 or 3. In this case, if we just sold the call by itself, we should know this, okay? We've been taught better than this, okay? You do shares, you sell the call, classic covered call. What do you call it when you do them at the same time? Buy right. Buy the shares, write the call. We know that. Now, why would someone do this position? Well, they want to have a higher delta strategy. The con of this position, the pro about this position is you get a credit. There's a built-in max gain. The con about this strategy is the risk is the stock going all the way to 0. Now, in this market, many investors might say, I'm not concerned about the stocks going up. I'm concerned about them going down. Now, the biggest thing to always remember is protect the purse. Because if you lose money, you got to make the money back at a higher percentage of the portfolio value to get back to break even. So many investors might say, look, I'm not going to try to be overly bullish in a more volatile market. I'm going to try to be bullish, but protecting the downside, protecting the purse that's holding the capital. Okay? Now, you protect the purse. You're probably also by the way, the men are saying, well, I don't have a purse. I got a wallet. Okay, fine. You got a wallet or a briefcase. Now, the big thing in this case is we're going to come over here to the put side, and we're going to try to buy a delta of, let's say, 30 to 40. Now, when we do this position, we're trying to use the call premium to fund, okay, the put. The problem is, in this case, it's not going to be exactly perfect. If we come over here and buy a put with a delta of 30 to 40, it's going to be 370. Now, what is that really going to do? Well, that means that out of the pocket, we're going to have to spend about $75 to have the collar on. Now, when we do the numbers, now remember, take out a sheet of paper, okay? And if we look at these numbers, if we buy these shares if you guys and gals don't mind, I'm just going to say that we're going to buy them at 120. Why is that? Well, easier math, okay? So forgive me. If you want to add the 27 couple cents, fine. So if we look at this on the downside, okay, you got about 115, okay? Now, from that simple math, 120 to 125, $5. Now, we got to ask ourselves, are we getting a debit? Are we getting a credit, a plus, or are we actually getting a minus, a debit? Well, you got to pay for it. And what's that? It's a debit of 75 cents, meaning the credit for the call is not enough to pay for the put. The $5 that was from the current stock price up to the short call strike, 125. That's why we had $5. So the maximum gain we can make on the upside is about $425. Okay. And James, that's not true because it's a little bit more than that. I'm just saying easy math. Okay. Now, if we look at the downside, you're going to see if we go from 120 down to 115, well, that's negative $5. Now, again, do you get a credit or a debit? Well, in this case, we get a debit. And so what you're now going to notice is you got to pay the 75 cents. And what's the risk of the downside? About $5.75. Now, we said before that when you actually look at, let's say, like a caller strategy like this, it is very similar to like a long call, vertical, etc., where the maximum reward to the maximum risk is usually about dollar for dollar. Now, in this case, if you're kind of a little bit, it depends also sometimes where you are, where the stock is in relationship to the strikes. It could also be dependent upon what the volatility is. If this stock has earnings coming up, the puts might be more expensive than the calls. Okay? Now, what we're going to do in this case is we're going to buy those shares, sell the call, and also buy the put. Now, again, I hate when people say this because they're like, I wish I would have protected my position. I am trying to give you opportunity to learn how to protect your portfolio. Okay? So in this case, if you said, hey, James, I already buy shares already, wonderful. Okay? Now, if we look at this position, what does it look like? It looks like a long call vertical. Maximum gain. Now, you guys remember that $475? Well, there it is on the diagram. Remember when we kind of talked about a $575 loss when we looked at the math? There it is. Okay? Now, when we look at, let's say, this trade, if we send it through, okay, if we did that, you're now going to see that position, if I go confirm and send, the delta on this position, and by the way, you could just look at it and kind of see for yourself. If we buy 100 shares of Target, the delta is 100. Fine. You sell the call, negative 36. You buy the put, negative 35. So if we had 100 less 36, less 35, it's going to give us, what is that, 29 delta total when you combine them all? So that means that if the stock goes up $1, we're not making a full 100. Why? Because you have a short call and a long put. Stock goes down $1, we're not going to lose $100 overall. It should be down about negative $29. Okay? So the caller strategy, this is really like doing buy, write, protect strategy. Buy the shares, write the call, take that call premium to buy the put. And at the same time, what we're going to see in this case is, can we actually get the stock to move to the upside? When we go back to the diagram, if we ask ourselves the question, well, are we bullish or bearish? Well, we can see over here on this bottom, if we're right here at 120, and if the stock goes to the right or up, that line is going up. What does that tell us? It's a bullish strategy. Okay. Second thing we could actually see is what's the delta on the position. Now, are there any questions from you guys and gals? Okay. Now, Sam, that's kind of what we've been doing. I'm not sure if that's the part of it that you were asked. Yeah, just looking to see what your question is. Yeah, well, you're talking about the little much uncertain if you're for me. Well, that was kind of why we did the example buying the put below. So that stock is at 119.67. Right below the current stock prices, we have a right to sell those shares from now to expiration. Now, what's nice about this is the expiration is not just for the next 5 days. We got 45 days here to see if we can't get kind of some of these things that have been happening geopolitically to kind of taper down a little bit. And if that were to occur, pretty good chances that some of these stocks that have been pushed down might start to rebound back to the upside. Okay, and we'll have to see. But that's important with protection. Protection is not a stop indefinite. maybe 6 months or so, the protection is the expiration month that you're picking. Okay. All right. Any other questions there? Kind of out of my time. So the comment was, do you recommend the strategy more at higher VIX levels? That does make sense. I would actually say when the VIX is low and diverging, number one. But yes, you could actually say this strategy might be more conducive in higher volatility environments. So I'd say two things. Number one is when the VIX is low and diverging. And second, when the VIX is high and staying high. Yes. Now, you got Cameron May coming up next, okay? We talked about some current examples in the portfolio. We talked about exiting bearish positions, adjusting stops. We also talked about some examples of new bullish trades, following through on yesterday, but also some new ones as well. We also talked about that collar strategy as well and practicing in that. Now, remember with what we discussed, it was done for example, illustrative purposes only. And always remember that investing involves risk. That's why we want to be mindful of what that risk is. Barbara will be teaching later this afternoon on getting started with technical analysis. Join us. And also remember that Cameron May will be coming up next. And with that said, this has been the Class on Investing Master Series. And I will be teaching throughout the week. But just remember, Friday, the market is closed because it's Good Friday. Thanks so much. Stay tuned for Cameron May coming up next. Bye-bye.